Do you really need 10 or 15 different investments to build a diversified portfolio? Or could one ticker do most of the work? That question is worth asking because the number of ticker symbols in a brokerage account does not necessarily tell you how diversified the portfolio really is. 20 individual Canadian stocks can still leave an investor concentrated in one country and a handful of industries. Meanwhile, one all-in-one ETF can provide exposure to thousands of companies across Canada, the United States, developed international markets, and emerging markets. One example is XEQT, the iShares Core Equity ETF portfolio. XEQT is designed for investors who want a globally diversified equity portfolio in a single Canadian-listed fund. But simplicity does not mean safety, and one ticker does not mean one investment. So let's look at what XEQT actually holds, what it costs, how the taxes can work, and most importantly, what kind of investor may or may not be comfortable owning it. This video is for educational purposes only and is not personalized financial, investment, tax, or legal advice. XEQT is an all-in-one ETF managed by BlackRock Canada under the iShares brand. Instead of requiring an investor to separately choose Canadian, US, international, and emerging market ETFs, XEQT combines those exposures into one fund. Its strategic asset allocation is 100% equity. In other words, this is essentially an all-stock portfolio. There is no strategic bond allocation designed to cushion equity market declines. That is the first thing to understand, because XEQT can be diversified and still be volatile. Broad diversification helps reduce the risk of depending too heavily on one company, one sector, or one country. It does not eliminate stock market risk. If global equity markets fall sharply, XEQT can fall sharply as well. Inside the fund, the allocation is roughly 45% US equities, about 25% Canadian equities, about 25% developed international equities, and about 5% emerging markets. Those weights can move around as markets change, and the fund is monitored and rebalanced to keep the portfolio close to its strategic allocation. That creates exposure to thousands of underlying securities rather than a small collection of individual stocks. There is another detail here that is easy to misunderstand. XEQT is not simply the global stock market weighted exactly according to each country's share of world market capitalization. Canada receives a much larger allocation than its weight in the global stock market. That is intentional. So describing XEQT as simply owning the entire world according to market size would be inaccurate. A better description is this. XEQT is a globally diversified all-equity portfolio with a deliberate Canadian home country allocation. Now think about the practical side. Someone building a similar portfolio manually might buy one Canadian ETF, one US ETF, one developed international ETF, and one emerging markets ETF. That approach can work perfectly well. It also creates additional decisions. How much belongs in each fund? Where should the next contribution go? What happens after the US market has an unusually strong year? Should some US exposure be sold and redirected toward Canada or international markets? XEQT handles much of that portfolio maintenance inside the fund. BlackRock describes the portfolio as continuously monitored and automatically rebalanced as needed to maintain its target weights. That is one of the main reasons an all-in-one ETF can appeal to investors who value simplicity. Not because rebalancing is impossible to do manually, it isn't, but every additional decision creates another opportunity to procrastinate, second-guess the plan, or react emotionally to whatever market happens to be performing best at the moment. Now let's talk about fees. There are two different numbers worth understanding. BlackRock currently lists XEQT's management fee at 0.17%. That management fee was reduced in December 2025. The currently reported management expense ratio, or MER, is 0.20%. The MER is useful because it reflects the fund's management fee plus certain operating expenses and taxes. What does 0.20% mean in actual dollars? Consider a hypothetical $100,000 portfolio. At an MER of 0.20%, the annual fund expense would work out to roughly $200 if the portfolio stayed at exactly $100,000 for the entire year. In reality, portfolio values move, so the actual amount would move as well. And the MER is not normally charged as a separate bill that appears in the investor's mailbox. Fund expenses are reflected in the value and performance of the fund. Now compare that hypothetical $200 with an investment charging an MER of 1.5%. At $100,000, 1.5% represents about $1,500 per year. That is a difference of roughly $1,300 in a single year before considering the effect of compounding. The point is not that every mutual fund charges 1.5%. They do not. The point is that fees deserve attention because even relatively small percentage differences can become meaningful over long periods. But low cost is only one part of portfolio construction. A low-cost investment with the wrong risk level can still be inappropriate. Now, there is another advantage that matters specifically to Canadian investors. XEQT trades on the Toronto Stock Exchange in Canadian dollars. So an investor purchasing XEQT does not need to convert Canadian dollars into US dollars simply to buy the ETF. There is no requirement to perform Norbert's Gambit or maintain US dollars just to purchase XEQT. But here is the important distinction. Buying an ETF in Canadian dollars does not eliminate foreign currency exposure. The companies and underlying investments inside XEQT operate around the world. Changes in exchange rates can still affect the Canadian dollar value of those foreign investments. The currency used to buy an ETF and the currency exposure of the investments inside that ETF are not the same thing. Now we need to deal with one of the most confusing parts of Canadian ETF investing: foreign withholding tax. A common shortcut says that U.S. dividends face withholding tax in a TFSA, but avoid it in an RRSP. That can be true for certain investments held directly, but it is too simplistic for a Canadian-listed fund of funds such as XEQT. According to BlackRock's Canadian withholding tax guidance, U.S. withholding tax can apply inside Canadian-listed ETFs that hold U.S. equities, including when those Canadian ETFs are held in an RRSP, RRIF, or TFSA. By contrast, qualifying U.S.-listed ETFs or U.S. stocks held directly inside an RRSP or RRIF can generally benefit from the Canada-U.S. treaty exemption from U.S. dividend withholding tax. That does not automatically mean investors should restructure their portfolios around withholding tax. Account selection involves much larger considerations. An RRSP can provide a tax deduction when contributions are made, while withdrawals are generally taxable income later. A TFSA does not provide a deduction for contributions, but qualifying withdrawals are generally tax-free. Current tax rate, expected future tax rate, available contribution room, retirement income, withdrawal plans, and other circumstances can all matter. Foreign withholding tax is one piece of that puzzle, not the entire puzzle. And because tax circumstances differ from person to person, individualized tax decisions may require advice from a qualified professional. Now let's compare XEQT with a few alternatives. Start with VFV, the Vanguard S&P 500 Index ETF. VFV provides exposure to the S&P 500, meaning large U.S. companies. Its reported MER is approximately 0.09%. That is lower than XEQT's reported MER, but comparing the two only by fee would miss the larger difference. VFV is fundamentally a U.S. large-cap equity investment. XEQT combines U.S., Canadian, developed international, and emerging market equities. So the real question is not simply, which one is cheaper? The real question is, what exposure is the investor trying to own? Someone using VFV as an entire equity portfolio is making a much more concentrated geographic decision than someone using XEQT. That concentration could help during periods when large U.S. companies outperform. It could hurt during periods when other markets perform better. Nobody knows with certainty which region will lead markets over the next decade. That uncertainty is one of the arguments for geographic diversification. Another alternative is VEQT, the Vanguard All-Equity ETF portfolio. VEQT follows a similar one-ticket, all-equity concept, but the construction is not identical. VEQT currently allocates more to Canadian equities than XEQT and uses Vanguard's own underlying ETFs, Its underlying allocation recently included roughly 45% US equities, about 30% Canadian equities, about 18% developed markets outside North America, and about 7% emerging markets. So the question of XEQT versus VEQT does not require declaring one universally superior. Both are all equity asset allocation ETFs. They simply implement that idea differently. Then there is individual stock picking. Managing 20 stocks means following 20 businesses. That can involve earnings reports, financial statements, changing valuations, competitive threats, management decisions, and repeated choices about whether to buy more, hold, or sell. Some investors enjoy that process. Some have the time and expertise to do it. Others have no interest in turning portfolio management into a second job. For those investors, broad index funds can dramatically reduce the number of decisions that need to be made. That does not guarantee better performance, it simply changes the process. Instead of trying to identify which individual companies will outperform, the investor owns a broad collection of businesses and accepts market returns, minus costs and tracking differences. Now comes the most important question. Who might find XEQT appropriate? It may be worth considering for a long-term Canadian investor who wants broad global equity exposure, values simplicity, understands that the portfolio is essentially 100% stocks, and can tolerate significant market declines without abandoning the strategy. But that last part matters enormously. An investor can understand diversification perfectly and still discover that an all-equity portfolio is too volatile emotionally or financially. Imagine watching $100,000 temporarily fall to $80,000 or $75,000. Would that create panic? Would it lead to selling? Would the money be needed during the decline? Those questions matter more than whether the ETF is convenient. And for someone approaching or already in retirement, the discussion becomes even more important. Retirement portfolios are not only about maximizing long-term growth. Withdrawals matter. Liquidity matters. Reliable income matters. Sequence of returns risk matters. If a retiree experiences a major market decline while simultaneously withdrawing money to pay living expenses, selling investments during that decline can make recovery more difficult. That does not mean retirees cannot own equities. It means the appropriate equity allocation depends on the person's entire financial situation. Income from CPP, OAS, workplace pensions, annuities, employment, or other sources may influence how much portfolio risk is reasonable. Cash reserves may matter. Expected withdrawals may matter. Risk tolerance may matter. And the time horizon for different portions of the portfolio may matter. For investors who want an all-in-one approach with less equity exposure, iShares also offers funds such as XGRO and XBAL. XGRO targets approximately 80% equities and 20% fixed income. XBAL targets approximately 60% equities and 40% fixed income. Adding bonds does not guarantee that a portfolio will avoid losses. And a balanced portfolio is not automatically appropriate just because someone has reached a certain age. But changing the stock and bond mix is one way investors can adjust portfolio risk. That brings us back to the original question. How many investments do you actually need? The answer is not determined by the number of ticker symbols. One ETF can contain thousands of securities. 20 stocks can still represent a concentrated portfolio. What matters is what those investments actually contain. XEQT offers one example of a simple structure. One Canadian-listed ETF. A strategic allocation of 100% equities, exposure to Canada, the United States, developed international markets, and emerging markets. Automatic rebalancing. A currently reported MER of 0.20%, and thousands of underlying securities. That combination may appeal to investors who want an aggressive, globally diversified portfolio without manually managing several funds. But XEQT is not automatically the smartest investment for Canadians. It is not automatically the best retirement ETF, and it is not a complete answer for every investor, simply because it comes in one ticker. The appropriate portfolio depends on the job the money needs to do. How long will it remain invested? When will withdrawals begin? How much volatility can the investor tolerate? How much liquidity is needed? What other income sources exist? What are the tax implications? And perhaps most importantly, is the strategy simple enough to follow through both good markets and bad ones? That is the real attraction of an all-in-one ETF, not excitement, not a promise of superior returns, not a shortcut to getting rich. Simplicity, diversification, automatic maintenance, and fewer decisions. Sometimes a sophisticated portfolio has many moving parts, and sometimes sophistication means understanding exactly what you own, choosing an appropriate level of risk, and deliberately keeping the rest simple. Subscribe for more Canadian investing breakdowns, and I'll see you in the next one.